Think your business is safe because you made a profit. Your financial statements might be telling a completely different story, and you need to see it. Financial statements tell you the numbers, but they don't tell you the full story. Most people look at the income statement and balance sheet and stop there. There's a mistake. The real explanations why profits changed, how numbers were calculated, and what risks exist are hidden in the notes that almost everyone skips. Think of the notes as the behind the scenes version of the business. They explain one time events, accounting choices, debts, and problems you will see in the main statements. If you ignore them, you are judging a business with incomplete information. Read them and you understand what's going on. What are notes to financial statements? Notes to financial statements are extra explanations that suppose the balance sheet and income statement. They explain the assumptions, accounting policies, and estimates used to prepare the numbers, and they provide detailed disclosures that assess liabilities and possible risks or obligations that don't fit neatly into the main statements. Ignore them, and you invite the risk of making decisions based on incomplete or misleading information. Why they matter? Notes to financial statements improve transparency and build trust. They give investors, banks, and management the context they need to make informed decisions. Without notes, the main statements can look clean and positive while important details stay hidden. You could care because this is the they, you should care because this is where the real risks hide. A business might look profitable on paper, but the notes can reveal debt obligations, legal issues, and or accounting choices that completely change the picture. Common sections in notes. Notes to financial statements usually follow a similar structure across companies. They include accounting policies and estimates, detailed information about assets and liabilities, contingent liabilities and commitments, and related party transactions. While the depth may vary, these sections are almost always present. Each section serves a clear purpose. Accounting policies explain the rules the company follows. Assets and liability details show what the numbers are really made of, and contingent liabilities highlight possible future risks. When you understand these sections, you are making decisions with clarity. Real world problems about lease obligations. On the income statement, you might only see a monthly lease expense, say $5,000. On the surface, that looks manageable, but the notes to financial statements tell a deeper story by showing the total lease commitment over time. For example, the notes may reveal a 5-year lease worth $300,000. That changes how you look at cash flow, risk, and financing decisions. A business can look healthy today, but those future obligations matter to investors, lenders, and owners who need to plan beyond the next month. Accounting policy disclosures. Disclosures explain how a company records revenue and expenses and which methods it uses for inventory, depreciation, and amortization. They also highlight any changes in estimates or policies so readers know when numbers are no longer being calculated the same way as before. Think of these disclosures as the rules of the game. Without them, the numbers can be misleading. For example, if a company switching its inventory method from FIFO to weighted average, reported profits can change significantly. The notes make date change visible. Without them, you would never know why the numbers suddenly look different. Contingent liabilities and risks. Contingent liabilities are potential obligations that don't appear directly on the financial statements yet. These can include lawsuits, loan guarantees, or environmental claims that might turn into real costs in the future. Because they are uncertain, they are explained in the notes instead of being recorded as actual as actual liabilities. For example, a company may be facing a lawsuit that could cost millions. You won't see that number on the balance sheet, but the notes will flag the risk. This is critical information for investors, managers, and even freelancers managing client accounts because hidden risks can quickly change a financial business's financial reality. Related party transactions are deals a company makes with owners, management, or affiliated businesses. Because these parties have close relationships, there is a risk the transactions aren't on fair market terms, which can create conflicts of interest. That's why they appear in the notes. These disclosures let investors and regulators see if numbers are being inflated or cost hidden. When conflicts exist, transparency becomes essential for trust and informed decision making. Differences across businesses. Notes on financial statements vary depending on the size and complexity of the business. Small and medium businesses usually have simpler notes with fewer disclosures. Startups often focus on fundraising, details, and potential liabilities, while large enterprises provide extensive multi section notes covering every aspect of their operations. In short, notes are scaled and with complexity. A small startup might have just a single page explaining accounting policies, whereas a multinational could have 50 plus pages of detailed notes. Understanding what to expect based on business size helps you focus on the information that truly matters. How notes build trust. Notes on financial statements show transparency and consistency, helping prevent surprises or misinterpretation. They give lenders, investors, and other stockholders a clear view of the company's financial reality. Trust is everything in business. When a company discloses details clearly in the notes, it reduces ambiguity and builds credibility. Stockholders can make decisions confidently because they understand the full story behind the numbers. Quiz time. Where would you find information about a potential lawsuit? Balance sheet, notes, cash flow statement. Pause the video and drop your answer in the comments. If you insist, the correct answer is notes. This shows how notes complement the main financial statements by revealing risks and details you won't see in the code numbers. Practical action steps for freelancers and SMBs. If you are a freelancer or SMB owner, don't skip the notes when reviewing financial statements. They are a roadmap to understand the business beyond numbers. Summarize key disclosures in plain language like lease obligations, accounting methods, or potential lawsuits, and keep your own notes for reference. This simple habit makes your financial analysis smarter and your decision making more confident. Real world scenario. The small business seemed perfectly fine. The balance sheet looked healthy and profits looked good. But the owner overlooked the notes, which revealed significant vendor payment obligations. These hidden commitments ended up impacting cash flow. If the notes had been reviewed, the owner could have avoided a cash crunch. Stories like this show why financial literacy isn't just about numbers, it's about understanding the full picture. Key takeaways. Notes reveal the story behind the numbers and are essential for transparency and trust. They highlight risks, explain accounting choices, and make financial statements truly understandable. In short, notes aren't optional, they are a crucial part of any financial analysis toolkit. Think of them as the commentary track on a movie. They give context, clarity, and insight that the main numbers alone can't provide. Next time you review a financial statement, check the notes where the real story lives. Drop a comment below sharing one thing you discovered in financial notes recently. Have questions? Ask away. And don't forget to subscribe for more practical business tutorials that help you make smarter decisions. Engage, share, and learn. Your future self will thank you.